Best cities to invest in real estate in 2026. Cash flow, growth, and real demand. If you are trying to figure out where to buy your next rental property in 2026, you are not alone. With some markets cooling off, others heating up, and interest rates still higher than what we got used to, picking the wrong city can destroy your cash flow. In this video, we are breaking down some of the best cities to invest in real estate in 2026 based on 3 things that actually matter: affordability, rental demand, and long-term stability. We will talk about why investors are targeting these markets, what types of deals make sense there, and what to watch out for before you wire a single dollar. By the end, you will have a short list of markets you can actually start researching and underwriting deals in right away. Let's get into it. Before we name specific cities, let's quickly talk about what makes a best city for investors in 2026. A lot of lists online just chase appreciation or hype. As an investor, your focus should be on a balance of 1. Affordable entry prices, 2. Strong rent-to-price ratios and cash flow, 3. Stable or growing job bases so tenants can actually pay you, and 4. Landlord-friendly or at least landlord-neutral regulations. In 2026, that profile shows up much more in the Midwest, certain southern markets, and selected secondary metros than in the ultra-expensive coastal cities. City number 1, Cleveland, Ohio. Cleveland keeps showing up as one of the top cash flow markets in the country because it combines low purchase prices with solid rent-to-price ratios. That means you can often get into a single-family or small multifamily deal at a modest price point while still achieving attractive cap rates. Cleveland has a diversified job base anchored by healthcare, education, and manufacturing. Those sectors are not flashy, but they are sticky, and they support consistent rental demand. For investors, this translates into a steady pool of renters who need housing close to work. In practical terms, Cleveland is attractive for buy and hold investors who prioritize cash flow over massive appreciation. The focus is on bread and butter workforce housing, 3-bed homes in solid B or C+ neighborhoods and small multifamily. You still need strong property management and realistic maintenance reserves, but your entry price and monthly cash flow can look very compelling compared to coastal markets. City number 2, Indianapolis, Indiana. Indianapolis has quietly become one of the most mentioned, steady markets for long-term investors. It offers affordability, population growth, and a growing logistics and services economy. The city sits at a crossroads of major transportation routes and has attracted warehouses, distribution centers, and related jobs, alongside healthcare and professional services. For investors, Indianapolis offers predictability, relatively affordable home prices, a broad base of rental demand in both the city and suburbs, and a landlord-friendly environment. Many investors like single-family rentals in established neighborhoods, as well as newer build rentals in the suburbs where tenants will pay for extra space and better schools. The play here is often a balanced approach, decent cash flow plus modest but steady appreciation over time. City number 3, Pittsburgh, Pennsylvania. Pittsburgh combines affordability with steady demand. Median prices remain relatively low compared to many coastal and Sunbelt markets, and the city has a growing tech, healthcare, and education presence layered on top of its historic industries. That mix supports a diverse renter pool: students, medical workers, young professionals, and blue-collar tenants. For investors, Pittsburgh offers an opportunity to buy into a market with decent yields and a strong identity. Typical plays include single-family rentals and small multifamily properties near universities, hospitals, and employment centers. Some neighborhoods may also offer value-add opportunities where you can cosmetically upgrade older housing stock to attract higher-quality tenants. City number 4, Kansas City, Missouri. Kansas City has been on investor radar for years and remains a reliable middle-market performer. It benefits from solid rent growth trends, revitalized development, and affordable entry points, particularly for small multifamily investors. It is big enough to have real economic diversity, logistics, healthcare, manufacturing, professional services, but not so overheated that investors are routinely chasing negative cash flow. The Kansas City play is often small multifamily and value-add single-family, buying properties that are structurally sound but cosmetically dated, improving them to the standard local renters want, and holding for cash flow. City number 5, Birmingham, Alabama. Birmingham is mentioned for its below national average home prices and high percentage of renters. The city benefits from growing healthcare and education sectors, and many investors target duplexes and small multifamily properties to generate stronger monthly cash flow.
Birmingham is not usually the first city newer investors think of.
But that is part of the opportunity. It flies a bit under the radar compared to Sunbelt hotspots that have seen massive price spikes.
The key here is solid on-the-ground management and conservative underwriting, including adequate reserves for repairs and insurance. City number 6, Memphis, Tennessee. Memphis has a long-standing reputation as a cash flow market. The city's economy is driven heavily by logistics and distribution paired with relatively affordable housing and favorable landlord regulations. Investors are drawn to the numbers, low purchase prices and strong rent-to-price ratios, especially in working-class neighborhoods where tenants rent long-term. Success in Memphis usually requires disciplined tenant screening, realistic maintenance budgeting, and strong management, whether in-house or through a local property manager. City number 7, Columbus, Ohio. Columbus shows up repeatedly on lists of attractive real estate markets. It benefits from a major university presence, a growing tech and professional services scene, and population growth. For investors, Columbus offers a mix. More appreciation potential than some pure cash flow markets, and still reasonable entry prices compared to coastal hubs. Deals that make sense here include single-family rentals in growth corridors, small multifamily near employment centers, and value-add properties in transitioning neighborhoods. City number 8, selected Sunbelt value markets. While many Sunbelt cities have become expensive and more volatile, some still deserve attention because they blend buyer leverage with long-term migration trends. Certain metros in states like Georgia, Florida, North Carolina, Nevada, and Texas offer better value than nearby high-cost hubs while still attracting new residents. From an investor perspective, this means you may be able to negotiate better deals in 2026 than in the frenzy years, particularly if you focus on value segments rather than ultra-luxury. In these markets, appreciation and long-term demand can be attractive, but cash flow may be thinner unless you are strategic about location, asset type, and pricing. The play might be hybrid deals, properties that produce modest cash flow today, but are positioned in growth corridors where rents and values can climb over time. Now, before you rush out to buy in any of these cities, we need to talk about how to use this information intelligently. Just because a city shows up on a best markets list does not mean every deal there is good. The worst deals happen when investors assume the market will rescue a bad purchase. Here is how to turn a city list into a real investing strategy. Step 1. Pick 1 or 2 markets and go deep, not wide. Instead of chasing 10 cities at once, select 1 or 2 that match your goals. If your primary goal is cash flow and you are comfortable with older housing stock and more hands-on management, you might prioritize places like Cleveland, Memphis, or Birmingham. If you want more balance between cash flow and appreciation, you might focus on Indianapolis, Columbus, Kansas City, or Pittsburgh. If you are comfortable with thinner cash flow but want long-term growth and migration tailwinds, you might look at selected Sunbelt metros. Step 2. Build a buy box for that market. A buy box is a clear set of criteria that defines your ideal deal. For example, 3-bed, 2-bath, single-family homes between 1,200 and 1,800 square feet in these zip codes, built after 1975, at or below a certain purchase price, or duplexes and fourplexes in B neighborhoods with pro forma cap rates above a target percent. The city is just the starting point. The buy box keeps you disciplined as you look at actual listings and off-market deals. Step 3. Study rents, not just prices. Once you have a candidate market, you want to confirm rental demand and rent levels. Look at current rent listings, talk to property managers, and analyze the rent-to-price ratio for typical properties in your buy box. Many of the best markets reports highlight cities where lower home prices pair with strong rent demand, and you want to see that show up in your own research. Step 4. Pressure test your numbers with local experts. A spreadsheet from across the country does not tell you everything you need to know. Talk to local agents, property managers, and investors. Ask them, which neighborhoods are investors avoiding and why? Where are tenants actually paying on time? What price points move quickly on resale? The cities we discussed are all promising in 2026, but local nuance still matters a lot. Step 5. Match financing to the market and asset. The way you finance a deal in a cash flow Midwest market will look different from how you finance a deal in a more appreciation-driven Sunbelt city. In more affordable markets, investors often use DSCR loans, local banks, or portfolio lenders that understand small investors and rentals. In more expensive markets, you might lean more on partnerships or creative structures to get in without over-leveraging. The bottom line is this: in 2026, the best cities to invest in are not just the ones with the highest appreciation charts. They are the cities where you can still buy right, get solid rent-to-price ratios, and rely on real economic drivers, not just speculation. Markets like Cleveland, Indianapolis, Pittsburgh, Kansas City, Birmingham, Memphis, Columbus, and selected Sunbelt metros are worth a serious look because they check multiple boxes: affordability, rental demand, and long-term viability. Your job now is to pick the one or two that fit your strategy, build a clear buy box, and start analyzing real deals.
And before you go, if you found this breakdown of the best cities to invest in 2026 helpful and you want more content on real estate investing, DSCR loans, and step-by-step strategies for new investors, make sure to hit that subscribe button and turn on notifications so you do not miss any of my future videos.